Hello, good afternoon, everyone. I'd like to welcome everyone on to this pre-budget tax briefing webinar this afternoon. It's great to host everyone. We've had a great response and we've got a good attendance today, so really pleased to have everyone on board. So my name is Carl Taylor. Also on the panel this afternoon, we've got Jerry Surtees, who's a chartered tax advisor here at Oldfield. We've got Angus Brewer, who's an ATT advisor, and we've got Jack Bennett, who also works on our tax team here at Oldfield. So we've got a good panel. So why are we here this afternoon? Well, this tax briefing event is really all about looking at the tax planning opportunities and the possible changes expected in the budget later this year. With all that's transpired during 2020, we think there could be some significant changes ahead. And while no one knows exactly what is going to happen, we feel it's really important to think ahead, to plan ahead, and to act ahead of time in these things. So I've got some key questions I'm going to be putting to the panel this afternoon on the possible announcements at the upcoming budget and some of the things that we need to be thinking about ahead of that time. And we want you to feel free to join in and post your questions as we go through. So if you can post your questions into the Q&A box as we go through the event, we'll pick these questions up and we'll address them as we go through. And if you're having any technical problems, feel free to contact us through the chat box. Otherwise, make sure you put your questions into the Q&A box and we'll catch them there. So the next budget is scheduled in for the 3rd of March this year. And I don't know if everyone can remember, but the last budget we had was back on the 11th of March, 2020. If we can all remember or think back that far, it does seem like quite a lot has happened in that intervening time. And indeed it has, so much has happened since then. There's been a massive change in the public finances. Tax revenues have fallen and government spending has significantly increased. And at the same time, the government has spent hundreds of billions on steps to tackle the virus and measures to support businesses throughout the crisis, which we're very thankful for. But it does mean that the OBR expects a budget deficit of nearly 400 billion for this tax year, 2020-21, which is going to take overall government debt to over 100% of annual GDP for the first time in 60 years. So it's very significant debt that's been incurred there as a result of this whole COVID crisis. So, very significant. Angus, what do you think? How is the government going to even start to reduce or repay this significant debt?
Yeah, well, it's a massive question, isn't it, Carl? As you say, the impact of COVID to the economy and to the government's finances has been enormous. And I think those of you who are on the last event we held in December will remember we had hosted Adam Chester, who's a guest speaker, a senior economist. And I think for me, looking at that was really stark for me, how much impact the COVID has actually had to the economy and how the level of government debt is extremely high. I mean, there's some interesting factors at play here, isn't there? Because we obviously had the election before this all happened, and the government made a lot of spending commitments as well, some of them quite bold. So with that, and along with COVID hitting the economy, we have got, the government does actually have quite a big black hole which needs filling. And the question, as you say, is how they're going to do that. And I suppose there's many ways, but one obvious way would be to increase taxes somewhere along the way. Now, we think it's going to have to happen somewhere. It's just a question of exactly sort of when and how that might happen. And in this second budget of the Chancellor, so this is the Chancellor's second budget, I mean, let's face it, he's actually facing some dilemmas here, because whatever he chooses to do will upset some people. If he doesn't raise taxes, then government potentially becomes unable to deliver on their manifesto pledges. But if he does raise taxes, he could risk alienating some of his supporters. So there's quite a few things at play, and I think it's fair to say that it's going to be an interesting budget ahead. I think the government did actually pledge originally not to raise income tax, national insurance or VAT. But as we all know, they are not the only taxes out there. And obviously we don't know exactly what's going to be announced in the budget on the 3rd of March, but there's a few areas which they could look at. There's been a few ideas floated around. We'll cover off a couple just come to mind. One is capital gains tax. We'll touch on this a little bit more, but that is a definite potential area which could be looked at by the government in this next budget. Another one would be pension changes. And there's been a lot of speculation for quite a lot of time over pensions and the changes to that, and it's been picked up and put down by chancellors over the time. And if they did make some changes to pensions, it could make quite a positive impact to their finances. So it's a speculation, we don't know, but there could be some changes on that front. The other area that comes to mind also is R&D, which having had quite a bit of involvement in R&D over a number of years, I think it's been fair to say it's been quite generous, the R&D tax reliefs for companies. So we could see a bit of reduction in some qualifying criteria and some benefits at some point on that. That's what's occurring to me, Carl.
Yeah, that's interesting, Angus. Yeah, so you've got three possible changes that could have been floated there around capital gains tax, pension changes, and R&D. Jack, do you have any other thoughts, any other ideas of how the government could meet this?
Yeah, thanks, Carl. As Angus mentioned, there's been quite a lot of speculation amongst tax advisors as to what could change. Another idea that has been mooted is a change to dividend tax rates. It's been quite often noted over the last few years, there's currently quite a significant gap between the dividend tax rate and the income tax rates. So just, for example, looking at the basic rate band alone, any dividend income in that basic rate band is taxed at 7.5%, whereas any income or salary is actually taxed at 20%. So there's been quite a few suggestions that more could be done to bring dividend tax rates closer in line with income tax rates. In reality, I'd be surprised if they brought it all the way up to income tax rates, but we could see some form of increase in dividend tax rates. And the other point that comes to mind is there was a report published by what's known as the Wealth Tax Commission in November last year, and that was basically suggesting that there could be a one-off wealth tax, and that could raise in the region of £260 billion for the government, which is obviously a significant amount. And the way it was suggested this would work would be that it'd be based on personal assets above 500k per person, or £1 million per couple, at a rate of suggested 5%. In reality, the Chancellor did comment earlier in 2020 that he didn't believe it was currently time for a wealth tax, and in many ways it's unlikely that the Conservative Party would want to bring forward that proposal or that tax. Typically you find this more likely to appeal to the ideology of a Labour-held government. A couple of thoughts I had, Carl.
Yeah, that's good. Thanks, Jack. So there's quite a collection of possibilities here, and it's probably really only scratching the surface of what could come up. So we've mentioned 5 different things there. We mentioned possible changes to capital gains tax, possible changes to pensions, possible changes to R&D tax reliefs, possibility of a wealth tax that's been floated, and possibility of dividend tax changes. But Jerry, out of those 5 points we've mentioned, which would you say is the most important for us to focus on and really plan ahead for right now?
Yeah, it's a good question. I mean, I think, any of them are possibles, but I think capital gains tax is the one I'd be focusing on right now. And there's really two reasons for that. One is that I think we're likely to, out of all of those, I think we're probably most likely to see something happening on capital gains tax in the budget. And secondly, there's something we can do about it now. So there's steps we can take ahead of the 3rd of March. And we'll come to that in a bit more detail in a moment, but that can't necessarily, the same can't necessarily be said for things like R&D or the wealth tax that Jack referred to. We've kind of got to wait and see what comes out in the budget and then kind of make our decisions, make our plans from there. But just before we kind of move on and kind of unpack that in a bit more detail, should I just cover off, do you think, on the basics of what capital gains tax is and how it works at the moment?
Yeah, go ahead, Jerry.
So capital gains tax, as the name suggests, is a tax on capital gains as opposed to income. So covering most commonly assets like property, land and buildings, or shares in a limited company. And it applies where you're selling an asset for more than you bought it for, fundamentally. So a simple example would be if you buy a property for £200,000, you sell it some years later for 500,000. What you're taxed on is the £300,000 uplift. And the CGT capital gains tax rates have always historically been lower than income tax rates. So, and at the moment we're talking about income tax rates of 20 or 40 or 45%, depending on your income levels, versus capital gains tax rates of 18 or 28% on residential property, and even lower at 10 or 20% on all other assets, depending again on your income levels. So as a result, you can start to see why this is a bit of a target. If the government could just kind of inch those rates up a bit closer to income tax rates, potentially they could rake in quite a bit more tax.
Okay, so you're really honing in there on capital gains tax, and you're saying you think that could be subject to some changes potentially in this budget, really because the capital gains tax rates are quite a bit lower than normal income tax rates. But just give us a few more thoughts on why you think it's going to be a target, why you think there's going to be changes here.
Well, firstly, the government have commissioned an independent review of capital gains tax by the Office for Tax Simplification, or the OTS, to identify ways this tax could be simplified, in inverted commas, which effectively means generate more tax. And the OTS have made a number of recommendations, some of which are a bit more kind of dramatic than others. And I guess as a result of that, there's a lot of noise in the tax press about possible changes in this area in the upcoming budget. And we generally find there's no smoke without some fire. So we really are kind of looking out for some changes. I suppose the other thing as well is there's quite a lot for capital gains tax. There's quite a lot of quite favourable tax reliefs and allowances, and there's a feeling in some quarters that these are maybe a bit too generous or a bit poorly targeted in terms of the government's policy objectives. So, and we've seen some areas being tightened up recently. For example, entrepreneurs relief in the last budget or last couple of budgets, and also the changes to the rules around main residence relief when you sell your own home. So you can start to see that with the need for the government to raise revenues and plug this gap, there's at least some pretty strong likelihood that there could be some changes in the budget.
Okay, so we've really boiled that down. We've really boiled it down to capital gains tax, and I suppose that's really what we're going to focus on for the rest of this event. And I guess we'll mainly be focusing on business assets here, capital gains tax in relation to business assets, but it could affect personal assets too, personal property, which we'll cover off briefly as well further into the event. So if the government do make changes to capital gains tax, what I really want to know is, what are the options for the government? What are the possible things they could change or announce on the 3rd of March in relation to capital gains tax? It might not be literally what they do, but what are the options for what are the avenues they could go down in relation to capital gains tax? Jack, You got some thoughts on that?
Yeah, as Jerry mentioned, there's been quite a wide range, quite a number of recommendations and proposals put forward. Broadly speaking, I'd say there's the three most likely options. So they could just simply increase the rate of capital gains tax to bring it closer in line with income tax. And that would just mean that any gain made would just be taxed at a higher rate. They could also choose to reduce the annual exempt amount, which, just to sort of step back and explain, the annual exempt amount allows each individual to make a capital gain of up to £12,300 per tax year without having to pay any capital gains tax. So then if the government could reduce that exempt amount, then it basically means that more of the gain will be taxable, and so it'll increase their tax revenues. And then the third option could be to look at changes to business asset disposal relief. So just that is the more recent name for entrepreneurs relief, as some may know it. And this basically currently allows gains to be taxed at 10% rather than 20% on some qualifying assets. And there have been quite a number of changes and discussions around this over the last few years. And really the Chancellor, he could restrict it further in terms of accessibility to that, or he could just remove the relief altogether.
So really what you're saying there, Jerry, Jack, any of those three changes would really mean that you'd be able to make less tax-free gains due to a reduced annual exempt amount, and any capital gains that you did make over and above that would be taxed at a higher rate than currently. So what do you say, Angus? What are some of the other avenues the government could go down in relation to capital gains tax?
Yeah, I think in addition to what Jack said, I think another few options or few avenues they could look at would be, one would be employee share schemes that could be affected. When you talk about capital gains tax, that is a subject or a particular point that comes up in relation to employee share schemes. And I guess this is particularly where they are not a government approved or a tax advantage scheme. And many of the employee share scheme kind of options out there obviously rely on low capital gains tax for their attractiveness. And if the capital gains tax rates went up, then they could lose a lot of their appeal. So that would be one area. Another area would be main residence relief, as has always been referred to. So further restrictions on that, on the main residence relief when you sell your own home, particularly on larger properties, and what actually qualifies under this could be changed. Not quite sure how popular that change would be, but that is one option. And another one, which is an interesting one that the OTS published in their report about capital gains tax to the government, which kind of doesn't really relate to capital gains tax, but it was on their report. And that is actually taxing owner-managed companies on undrawn profits. So to sort of, I think they're thinking about reducing the incentive to keep the cash and profits inside a company. So at the moment, obviously, a company makes some profits, pays corporation tax on that, and then distributes some of that as dividends. But I think this option we're putting forward was to actually tax the profits that are still left in the business, kind of almost tax it again. Quite how that would work and whether it would be fair or proportionate would be a question in my mind. I suppose realistically, a logical way of sort of tackling that would be to actually raise or increase the corporation tax rates. Now, that is a possibility. We haven't actually discussed that so far today, but that wasn't part of their original pledges of the taxes they wouldn't increase. So that could be one. And, you know, I think it'd be fair to say we wouldn't be surprised if we saw some increases in corporation tax rates, if not in this budget, over the next few years. We've got quite a competitive rate of corporation tax in this country, haven't we?
Yeah, that's right. And we just had a couple of questions ping in, actually. Well, one of them was are there any indications on what's going to happen to corporation tax? So you've kind of covered off on that one there, which is great. Just to take you back, Angus, to something you mentioned earlier on about possibility of pension changes. We just had a question come in about, could you expand on what pension changes are being contemplated? I guess there's nothing too specific exactly, is there, at this stage?
No, it's not quite the same in the same sort of ball game as capital gains tax, and there hasn't been any sort of formal reports or consultations into pensions as such in relation to this upcoming budget. So we just don't know exactly if there will be or what there will be in terms of changes on there. So I think it's a bit of a challenge to know what to say on that. It's just, I think the point is that there has been speculation probably over the last few budgets as some potential changes could be on pensions, but at this stage isn't really too much clue as to what they might be.
Oh, that's right. So it really looks like, Rishi's got quite a few options here. The Chancellor's got quite a few options to look at here. At the same time, he's really got to balance the whole current economic situation with anything that he does do, seeing as we're still right in the middle, in the thick of a health and financial crisis. So, okay, we've talked about a load of different options that could be action. We talked about a load of different options on capital gains tax that the government could take. But Jerry, of all those options we've outlined, what do you realistically reckon he'll do? What's our informed best guess on possible capital gains tax changes, Jerry?
Yeah, I mean, it's not an easy one to predict, but I think right now my kind of gut feeling is that it's going to be difficult for him to make some really significant, large-scale changes. Just, I think, with this state of the economy at the moment, it just doesn't really feel like the right time. And as we know, Conservative governments are not keen on tax increases at the best of times. And I doubt that they're going to want to stretch their goodwill too far with their voter base. But that said, I think I would be surprised if we didn't see some changes in this area. And I think my bets would be a possible reduction in the annual tax-free gains amount, what Jack went over earlier. It's currently pretty generous at 12,300 per individual per tax year. So we could see some reductions there. I think another one would be, as Jack touched on, increases in the capital gains tax rates from their current pretty low levels of 10 or 20% for most gains, or 18 or 28 for residential property. But I think I just think it's unlikely that we're going to see it going literally aligning with capital gains, with income tax rates. I just think that would be a hugely unpopular move that it would backfire on them, I think. I would be looking out for some restrictions on entrepreneurs relief, or business asset disposal relief as it's now called. So just as a quick reminder, that's the relief that allows you to reduce your tax rate from 20% down to 10% on up to £1 million of qualifying gains per individual. And as Jack said, they could even go as far as scrapping it altogether. We just don't really know at this stage. I would have thought that they're going to ring fence employee share schemes, government approved employee share schemes, because that's something that the government are pretty keen on, and their view is that it's quite a key economic driver. But we might see some tilting the balance in favour of government approved share schemes, which makes them more attractive compared to the sort of non-approved versions. So, of course, we don't know what's going to happen. We're going to have to wait for the 3rd of March for that. But I think that's our kind of summary of what we think is most likely.
Yeah, that's good, Jerry. So that's really your kind of your informed best guess of what probably may change. And we just got a question popping in here as to the timescales. So got a question here: are the possible changes Jerry's mentioned likely to be implemented from the day of the budget, which is 3rd of March, if they apply them. Or Jack, what do you say to that?
Yeah, typically any changes to the rates themselves, so 20%, 10%, will apply from 6th of April, the new tax year. Just practically because it's very challenging to change a tax rate partway through tax year. Any changes to the reliefs or the conditions you need to meet to get those reliefs is likely to have immediate effect from 3rd of March on the budget day. So where possible, if you need to use those reliefs, you need to get it done before then.
Yeah, no, that's helpful. So you're saying any changes to rates has really got to apply from the new tax year, otherwise it gets very complicated. But any changes to the conditions attaching to claiming reliefs could have immediate effect. So in the light of this, what are the key actions we should be considering ahead of the budget on 3rd of March? When you think about what the actions have got to be. So Jack, what do you say? I'll go around the whole panel and I'll get each of the panel to give me a key action that they think should be considered before the budget. So Jack, over to you.
Yeah, a couple of things come to mind. For any businesses wanting to incorporate into a limited company structure of some sort, I'd say it's important to make sure you act as soon as possible. Just practically speaking, it can take quite a few weeks to get everything sorted, both internally and legally. So if you're looking to incorporate from 1st of March, you'll need to make sure you're starting that process fairly soon. And the other situation is where a shareholder is looking to perhaps exit the business or sell some of their shares. It's common that you would need to request HMRC clearance before proceeding with the restructure. So just to explain, HMRC clearance is like a written confirmation from HMRC that they're happy that the transactions are taking place for a commercial reasoning, not for the avoidance of tax. It's unlikely that we'll be able to get HMRC clearance through and restructure before the 3rd of March. But if you're to act quickly, you should still be able to get that completed before the end of the tax year.
That's good. Thanks, Jack. And Jerry, what would you say? What's a key action we should be considering ahead of the budget?
Yeah, just to mention as well, on Jack's last point about clearance, just might be worth mentioning that we are seeing timescales extending quite a bit on clearances at the moment. And I think that's a general trend that many firms are seeing, not just us. And some transactions that we might have regarded as pretty sort of standard or uncontroversial in the past are taking longer, and HMRC are raising a lot more questions. Thankfully, we haven't had any of ours actually refused yet, which is good, but it is just extending the process, which is just the kind of backdrop to why it could be a bit tight getting anything in before the end of the tax year, so we'd need to act quite quickly. I think my key action would be to look at any property that you hold that would realise a significant gain if you were to sell it. And my question would be, should you be thinking about transferring that into another entity, for example, a holding company or a pension fund, now in order to realise that uplift in value while the tax rates are favourable? So that would particularly apply to, for example, businesses that have recently incorporated or changed their structure and are thinking of claiming entrepreneurs relief or business asset disposal relief. And we'd definitely encourage you to get in before the 3rd of March and make sure you do that now while the going's good. And it obviously also applies where you're selling a property to a third party in the normal way. And the key thing is that if you want to have certainty on your tax rates, that you ensure you exchange unconditional contracts before the 3rd of March. So it doesn't matter if you complete after, as long as you've exchanged unconditional contracts. Also, just as a slight aside on property that you're looking to develop, so it might just be a property that you've bought as an investment maybe, or even if you're wanting to sell off part of your garden or something like that, just be careful here and make sure you seek advice early on in the process, because even under current rules, if you are developing property yourself, then potentially you could be liable to income tax rates rather than capital gains tax rates, which are obviously a lot higher. And therefore would need to just think about what the most tax efficient way was of planning that to minimise your tax liabilities.
And Jerry, just a question on what you were referring to earlier about, property transfers and so on. What happens? What if there's no chance of a sale actually going ahead before the 3rd of March, before budget day, or even 5th of April, the end of the tax year?
Yeah, it's a good question, and one that does come up from time to time in various situations. But I think there's different ways that we can actually trigger a gain early, so that it allows you to trigger that gain while we've got certainty on the tax rates, realise a gain at low tax rates, and then if the sale then happens at some future date beyond the 3rd of March or beyond the 5th of April, then we've already realised our uplift at the prevailing tax rate.
That's good. And Angus, have you got a key action we should be considering?
Yeah, I think one key action for me, Carl, is to actually look at intellectual property. We haven't really discussed this so far today, but we have discussed it previously on previous events. But just to quickly cover off on that again, for everyone's benefit. So if you've got registered designs or registered trademarks, that's really what we're talking about when we're talking about intellectual property here. Then there might be some potential to move or transfer these and trigger a gain before the budget, say on the 3rd of March. So an example would be if you've got those registered trademarks or registered designs, if they're actually registered in your own personal names, then you might be able to transfer those to the company, effectively kind of sell them to the company, trigger a gain, and pay capital gains tax at the current tax rates. So I think that would be a key point for me, Carl, is just to review our intellectual property, just kind of make sure that we're not missing any opportunities on that front.
Yeah, that's good. I guess largely we've focused on quite a bit here on business assets. What if we've got personal assets, significant personal assets, other than say your main residence, such as a buy-to-let property portfolio held personally? Are there any thoughts on that?
Yeah, well, that is a good point, because as you say, we've focused mainly on the business, but the personal side could apply to some of the attendees. So as you said, I guess what we could be looking at is like a property portfolio, as you said, it's an example of buy-to-let properties. And I think the thing to think about here is, again, what opportunities or options are there ahead of this next budget? For example, whether it's advantageous to actually incorporate into a company to hold those properties. That's just an example. So definitely would be considering some options there. If you do have any other shares or investments of any kind as a personal asset, then I guess if you are considering cashing these up or realizing a gain, again, you may just want to think about the timing of those transactions in relation to the budget. So that's kind of a question about timing and options there. And then I guess it comes down to any other personal possessions. I guess we're looking at things that have got a significant value or where they've significantly increased in value, and whether we should be making any plans or actions on the basis of that. That's just a few thoughts on the personal asset side. I guess it's kind of covers that quite broadly, but
yeah, that's good. Thanks Angus, for that. Just before we sort of summarize those key actions, just a couple of questions that come in that I think would be good to address at this point. One here: what are your thoughts on inheritance tax changes? So what do we think on that? Has there been any noises on that? Angus or Jerry?
Yeah, well, I think it's an interesting one. I mean, there were some again, there was kind of some consultation and report done. I think it was back in this time last year, I think actually January 20, that was published, and that kind of led to some predictions. There might be some changes to inheritance tax in the last budget, so the first budget of the Chancellor, but that obviously didn't really happen. So yeah, it's a question of realistically what the changes could be on that front in this next budget. I don't know, Jerry, what do you think on that front?
Yeah, I mean, we certainly haven't picked up anything, any sort of vibes, if you like, that anything's going to change in the budget. You never know for sure. It's something that's often talked about. For example, the business reliefs are pretty generous at the moment, 100% relief on a lot of business assets and shares. But I think, again, I guess whenever the government are implementing tax changes, they've got to think about how well they're going to go down with the public. And inheritance tax, as we know, isn't the most popular of taxes at the best of times anyway, and doesn't in itself generate a lot of revenue for the government compared to other taxes. So I may be wrong on this, but my sort of feeling is that it's probably likely not to be a hugely high priority right now. Whereas capital gains tax, the reason, I guess, one of the main reasons why we're focusing on capital gains tax today is because there has been that consultation done, and also there's things that we can do ahead of the budget to improve our situation or reduce risk from changes.
Yeah, that's good. Thanks, Jerry. I don't know if there'd be anything else you'd say, just this other question we've got here about, would you say the mood music has quietened on the tax changes ahead of this budget?
Yeah, I mean, it's a good question, a good point. It kind of just feels like it's the wrong time, doesn't it, to be slapping big tax changes with everything that's happened around the pandemic and the way things have gone unexpectedly in the new year, and the extension of lockdown and so on. But I guess all we're really trying to do is be conservative and make sure that we're planning ahead. And if there are things that we can do ahead of the budget that are going to improve our situation, if there are any changes, then I think we'd be suggesting that you consider doing it.
That's good. Thanks, Jerry. So just to summarize those, to summarize on the key actions, hopefully everyone can see those on the slide there. You might want to take a note of these key actions that we should be considering. So the first one that Jack covered off was about considering incorporation ahead of 3rd of March. If that's something you're thinking about, we need to think about that target date there ahead of the budget. Another point that Jack mentioned was if you're looking at doing any shareholder buyouts or partial buyouts, question of looking at trying to push that through before the end of the tax year. There's reviewing property situation, as Jerry mentioned, looking at whether any transfers should happen ahead of the budget or ahead of the end of the tax year. And Angus also mentioned about reviewing your IP situation, any trademarks, registered designs owned personally, and whether they should be transferred into the company. And then there's also the other point Angus mentioned about reviewing any other personal assets, such as buy-to-let property portfolio, thinking about whether that should be incorporated, and thinking about doing that ahead of the budget or ahead of the end of the tax year. So some interesting things just for you to consider there. And, it kind of reminds me a little bit of something that an English footballer once famously said. That I think he said that he never makes predictions, and I'm never going to. That was something that he said, but we don't actually know what's going to happen. I think we thought it was far better to be thinking ahead, planning ahead, and acting ahead now. And then if nothing does change right now, nobody will have lost out. Exactly. So we always feel it's best to think as far ahead as possible. and act ahead of time. So to help you further with this, we've actually created a decision tree to help you decide whether there's anything you should be considering between now and budget day in early March. So we're going to be sending a link through to these after this webinar, so to look out for that on the email that will be coming shortly. But it's really like a flow chart, and you work through it from top to bottom and answer the questions as you go down, and it will eventually reach a conclusion at the bottom as to whether there's something you need to be thinking about here or not. So look out for those coming through after the webinar's ended. And if there's anything that you do want to discuss following what we've talked about, then more than happy to have conversations after this webinar. We're offering a short Zoom call to discuss anything further, and you can look out for a link to that on the follow-up email. So I guess we're really waiting in anticipation to hear what the Chancellor does announce in the budget, and we really want to be up to date with it as soon as it comes out. Angus, how do we find out what's been announced quickly after the budget statement on the 3rd of March?
Yeah, absolutely. That's going to be really key, isn't it? Because with all of the factors that we've discussed today and the whole backdrop to this next budget, I think it would be safe to say that it's going to be an interesting budget with lots of things at play, lots of factors behind it. You might say an interesting chapter in the history book. But I guess we know that everyone's busy. We know you're all busy. So how are we actually going to know about these changes as soon as we possibly can? So here at Oldfield, we're going to do a couple of things. The first one being at 4 p.m, 4 o'clock on the budget day. So that's the 3rd of March. We will be holding a live online panel discussion, a little bit similar to today, what we're doing now, where some of our consultants will actually go over the key points and the key announcements and just discuss anything pertinent that's kind of been announced earlier that day. So that's going to be pretty hot off the press. And for all of those attending the event today, on your follow-up email that you'll receive with a link to the decision trees, etc., you'll also get a link to register for this live panel discussion on the 3rd of March. So make sure you can register now. Make sure it's in your calendar so that you can keep up to speed. We will also be publishing more detailed budget commentaries and summary documents following the budget and circulating those. So watch this space for more coverage on that, and in particular, make sure you register for the event on the 3rd of March now, just so that you've got it there in your calendar, and you can be brought up to speed on the afternoon of the budget day.
Thanks for that, Angus. That's great. So that's how we can learn what's happened as soon as possible after the budget on the 3rd of March. So there's just one other question that's slipped in just while we were talking, which we need to just cover off before we finish. Question here: do you think the Chancellor will extend the current stamp duty holiday? It's an interesting question, and I guess the only person that actually knows the answer to that question is the Chancellor himself. But I don't know if anyone else has got any thoughts here. Jerry or Jack? Or...
Yeah, I agree with what you say, Carl. It's quite unknown at the moment. I think when it was first announced, it was fairly definite that it was ending 31st of March. But as we've seen with the furlough scheme, things it's had to be a moving picture. So it's, yeah, in a sense, I'd say it's anyone's guess.
Yeah, I think you're right, Jack. Things have had to be relatively flexible, like you said. Some of the things that have been announced have been extended beyond their end dates, but we really don't know on that one. Good. So we'd like to thank everyone very much for joining us this afternoon. It's been great to have you all on board, and thank you for the questions that you've put in. That's been really good to interact with the audience like that. That's been really good. So we'd like to thank you again for joining us this afternoon, and we'll look forward to catching up with you again soon. Thank you very much.